Hello everyone, and welcome again to Peterson Wealth Services Point of View. Well, we are officially transitioned over. We are now registered independently with the SEC. So congratulations to our staff and everybody here that made this possible. Thank to all of you out there who have helped us and been loyal to us along the way. It's quite a feeling to know that our firm is independent and now we can work with any client and any firm that custodies assets. All of our client accounts are going to stay with Raymond James for the most part, and we're continuing to have a great relationship with Raymond James as a whole. Today we want to talk a little bit about market sentiment, if you will, and some of the issues of today that are swirling around in the news media and in just little pockets of communities all over the country. So, you can talk a little bit about all these issues, from coronavirus continuing, the number of cases spiking, people continuing to worry about, cases, and how that's going to impact us, if any, the economy, if it's going to be re-shut down, and of course the election, which we're all kind of facing here in the next month. It's only a month away from election.
Here it comes, yeah. And we just had our first presidential debate, which was
circus?
I don't know really. Yeah, circus is probably a good word to describe it. But yeah, it's definitely the market feel. There's maybe a little pessimism out there, a little bit of worry, a little bit of angst. But it always seems like we get through that. When one issue comes up, we get through it, then we dive right into another issue. There's never blue skies for that matter. And I think the point of this video is just to talk about why it's important to stay the course. You always hear us say that term, stay the course, stay the course. And Kate will throw up a couple charts here showing you why it's important to stay the course. One thing we took a look at, and this was presented to us, this information by our friends at Hartford Funds, but going back to 1969 and looking at the 5 most recent drops of 30% or more in equity markets. And this chart doesn't even include the most recent one for 2020. But the point that we're showing here, if you look back at 73, 74, you have the Middle East oil embargo, Watergate. More recently in 2008, you see the housing bubble, financial crisis, and these steep declines. The point is they're going to happen. We just don't know when they're going to happen. But remaining invested is really shown to be the best course, and that's what Billy's going to talk about on his chart that Kate's going to throw up.
I agree 100% here with what these charts are trying to say, and this may sound like a replay or a repeat of past videos, but we think it's super important when we're going into uncertain periods of time that we continue to put the message out of what happens typically when investors get this anxiety feeling or this worry about what the future will hold. So they think they need to take action, and not just a little action. They want to take dramatic action in most cases. So Shaun, we've held a lot of client reviews and had taken many calls from clients, and even prospective clients, people who don't even work with us right now. They're worried about things, and they've been talking and using terms like cash, get out of the market, wait and see, not get invested now, the market's going to crash, this and that, because of whether it's a political concern, an election concern, or the economy being shut down again.
Yeah, there's actually areas of the market that are performing very well right now. I mean, the technology stocks, the NASDAQ, doing really good. The S&P and the Dow, they're kind of hanging around, positive, negative, depending on the day, but it's not like we've been in a terrible market. Yes, we went through a bad drop, but we've recovered those losses. But Billy's right. We're seeing a lot of people say, I want to wait and see, or I want to cash out. I'm not saying that anyone's done that, but that's the conversations that we're having. So that worry, that anxiety is at a high level right now.
So this next chart we're putting up now will kind of help us illustrate that point over the long term. This goes back to 1969, and this chart again provided by Hartford Funds, our friends over there, who do some great work and provided great material for us to relay back to our clients. This shows just an initial investment of $10,000 starting at the end of 1969, and then showing the results of that $10,000 based on different investment scenarios. So again, you have everywhere from an equity investor to a cash investor to the investor who reacts whenever there's bad news. And you can see these little panic buttons that we were showing on the previous chart. Each one of those panic buttons is listed there chronologically in the date that they occurred. So we can see that there were major sources of anxiety during those periods. And you can see what happened with the equity investor. Of course, significant declines in value, and then recovery, and then of course another decline when we had that shocking event, similarly to the pandemic of 2020. Now, this year has been a very, very difficult year to get through in a lot of ways. We're not only dealing with the pandemic itself and the fallout from that, but the fallout from the economic shocks and from the lockdowns, because a lot of people don't mention what's happening as an indirect consequence of the lockdown, which we think go hand in hand with the problems of today. Things like anxiety, depression, and many, many other consequences that I think we're going to deal with for a while to come. But this shows you, back to the point of equity investing is by far and away the best over the long term. You can see it far outperforms the balanced investor, which would include bonds and stocks. The bond investor exclusively ended up with $350,000 versus $1.5 million on the equity only. The reactionary investor did poorly, as you can see, reacting to only get out of the market and then wait. This chart kind of shows reacted on the day of the event, and then moved into cash or T-bills, and then moved back into the S&P 500 2 years later. So gave it plenty of time for the dust to settle, for everything to kind of get better, if you will, and feel more comfortable. A lot of times the market leave you behind when you do that. But this just kind of gives you a scenario if you were to do that every time a bad event occurred. And then the cash investor would just kind of humming along there on the bottom with not much to return over the concept of inflation. You know, you really have to be outperforming a 2 or 3% inflationary force in order to keep your money at the same purchasing power. So having come back to reality today and what we're facing next 30 days, 60 days, 90 days, we don't know if there'll be a contested election. There's a lot of uncertainty and things that we need to be prepared for. We have made some adjustments, and we will continue to watch all of our portfolios and every one of our clients. We take it very seriously here at Peterson Wealth Services, and we have some new technology that we're excited to be using now that we think is going to help us manage our portfolios better. But we'll look forward to talking to you guys again as news comes out. We'll be sharing what we see and what we hear and things that we're projecting right here with you.
Thank you for your time. Call us if you have any questions.